Welcome to Future 42. We thank you for taking the time to check out this video, and we pray that you receive this knowledge with an open mind and heart. Who can really tell you the steps to becoming a millionaire? 5.2 million people became millionaires in just 2021 alone, 2.5 of that residing right here in the United States. Yet very few took the same path to this wealth, nor can they build you a guide to follow that will guarantee the same results. Warren Buffett took 55 years to become a billionaire, while Jay Walker accomplished the same feat in less than a year. During the dot-com bubble, he founded Priceline.com, which begun the rise in his net worth and has propelled him from nothing to billions. However, Buffett is still at the top of the list of wealthiest individuals and doesn't appear to be falling off anytime soon. What is the difference in these two examples? Sustainability. When you ride a wave or the latest trend, you risk losing your momentum when that wave comes crashing to shore. Jay surfed his wave for as long as he could, but when it broke, so did his net worth. The wealthy accumulate money over a period of time through many milestones and continue to invest in new ventures as the opportunities arise. Money is a difficult game to play, so it is suggested that you play the game of life instead. To make it out of the rat race, your passive income must exceed your expenses. The challenge most individuals face is that they put a lot of effort into low-yielding activity. Some spend an entire lifetime working hard, but never amounting to any form of wealth because they lack the knowledge of how to allow their money to generate even more income. In other words, they lack investment knowledge and financial literacy. If you are here, don't worry. We have been there too, and here is the light at the end of the tunnel. Assuming that you have been diligently saving and now have an extra $1,000 in your bank account, pat on the back to you. This is an achievement by itself. Approximately 70% of Americans do not have an extra $1,000 in their bank account. Surely you can think of several things to spend that money on, like another useless gadget or a pair of shoes, or maybe even the vacation that you so badly deserve. Stop. Those things will come, but let's make sure that you can sustain that lifestyle in abundance. Investing that money has the potential to multiply and grow it exponentially, but the question is, how do you invest your first $1,000? Do you invest it in real estate or the stock market? Which types of stock do you purchase? Is $1,000 sufficient to begin investing? All of these questions and more will be answered in the next few minutes. So, give this video a thumbs up, and let's get started. To gain a better understanding of what investing is and how it functions, let's go through the following example. Imagine grinding your fingers to the bone for years at your job and managing to save up $300,000. You could go to a car dealership and buy a luxurious super sports car to show off your achievements. Or better yet, you could go buy real estate, a house, and rent it out to earn a passive income. You will receive at least $2,000 per month. You can choose to sell the property, recoup your initial investments, and much more, depending on the value of your property at the time you decide to sell. This is a perfect example of letting your money bring you more money. However, $1,000 is not enough to purchase a property in most traditional formats. So let's move on to things that you can invest your $1,000 into to watch it grow. The simple method is to just deposit it into a savings account and earn interest, but that is very minimal gains and in most cases takes about 24 years to double your money. Financial institutions will take your money and lend it to others at higher interest rates, and it will split the profit with you. However, this is never to the advantage of you. Imagine putting in $100 and getting only 0.083% interest back, but the bank lends that $100 to someone else and collects 16% interest. At this point, you are making them rich. This tactic is safe, but nowhere close to profitable because the extremely low interest rates on deposits. At 0.8%, your deposit of $1,000 will make you $8 in 12 months. No bueno. The Federal Reserve has an inflation rate of 2 to 3%, so any investment that you make yielding less than 2% is considered as a loss. Over time, the real worth of your $1,000 will decrease just based on inflation alone, meaning you'll be able to purchase fewer things each year. You may be asking why interest rates on deposit accounts is so low. The pandemic pushed the Feds to lower interest rates even more in hopes of encouraging people to borrow more money and spend more. Once we emerge from this crisis in a year or two, the Federal Reserve will raise interest rates to 1, 2, or possibly 3%, which will result in an increase in interest rates on savings accounts as well. This welcomes your second choice, government bonds. A government bond is a security that the government issues to raise capital to fund expenditures. If the government decides to build a hospital but lacks the funds to do so, it may issue an IOU, a document that states the U.S. government owes the owner of the security the sum of the security's value plus interest. Although this example is obviously oversimplified, the main idea is nonetheless conveyed. Since interest rates have been so low this year, government bond rates are less than 1%, although they were as high as 3% 2 years ago when interest rates were low. Considering that government bonds are the safest investments you can possibly make, this is not a terrible thing. All investments have a certain amount of risk. This is still the case even with the government. Least likely but still possible for them is to default on their loan. The fall of U.S. economy as a whole could cause the delay of default U.S. government to become bankrupt. Because of this, U.S. bonds are regarded as the world's safest investments. However, you should think about investing in the stock market if you want to earn a bigger return, like 10, 20, or 30%. For instance, just this year, the stock price of Amazon rose by more than 80%. The price of Google stock increased by close to 30%, while the value of Tesla stock rose by 721%. Yes, you heard correctly, 721%. Why would anyone invest anywhere else when they could potentially triple or even quadruple their money on the stock market is the typical question. The reason is risk. There isn't much risk when it comes to government bonds. However, there is a great chance that a company could collapse or take a major financial hit. Any unfavorable news, merger of competitors, or bad acquisition can cause the stock prices to fall. A product might be introduced by the company, as if consumers don't like it, it could result in some bad press, which could cause the price to drop. In other words, the bigger the return, the greater risk. Apple is a firmly established business with significantly lower failure risks than Tesla, but it also has less room for expansion than Tesla. As a result, Tesla grew by 721% this year, while Apple only increased 70%. How much risk you can accept without compromising your livelihood is a decision that only you can make. If you only have $1,000 left, it might not be a good idea to risk it all because you could lose the majority of it if things don't work out. This brings us to the topic of investing in an index, which is one approach that investors use to reduce their stock market risk. An index fund would essentially invest in the top 500 U.S. companies. The most well-known one, the S&P 500, monitors the 500 largest U.S. corporations. While some of these businesses will undoubtedly fail, others will prosper. The S&P 500's return rate has generally been around 10% since the 1920s. As a result, purchasing a share of one of these index funds entails purchasing a modest stake in 500 of the largest U.S. corporations. Our three absolute favorite index funds are the Fidelity Zero Total Market Index Fund, the Invesco QQQ, and Vanguard 500 Index Fund. How can I purchase shares in these index funds has to be a top 5 question that we get. You must first locate a broker. A person is qualified to sell stocks. In the past, a career as a broker was in high demand, so a simple phone call could get you any stock that you wanted practically on demand. The best example of this is a movie called Wolf of Wall Street. He would make calls all day long trying to sell people worthless investments. Fast forwarding to the year 2020, technology has finally conquered the industry, and the birth of the new development of apps like Robinhood, Webull, and others so that you can purchase shares from the convenience of your smartphone. Our goal was to keep this video as straightforward as possible so that anyone who wants to begin investing can feel empowered to begin this journey. We tried to address the most common inquiries in detail while still remaining brief. We know how frustrating it can be to want to begin the investing process with a million questions in your head. You then start investing into anything and everything until you are completely broke or ready to give up. If you found value in this video and would like this conversation to continue, give this video a like and be sure to subscribe to the channel for more helpful insight. Also, please comment below with any suggestions of videos that we can make to help further your financial journey. It has been our pleasure to share with you, and we look forward to pouring as much knowledge as you can handle. Peace and blessings.